A self-proclaimed billionaire listing his private jet and a $30 million mansion right after a brutal crypto wipeout, while investors whisper the word margin call. If that doesn't set off your BS detector, nothing will. I'm Thomas Paul, this is the comment section, and today we're digging into the Grant Cardone margin call saga, what it exposes about Cardone Capital, and what it means for your money. Here's where things get interesting because the question isn't just, is Grant getting margin called? The real question is, how can a guy in that position potentially make money off a margin call while his investors carry the risk? Here's the setup. You've got a flashy real estate guru, massive social media following, private jet, mega mansions, and a fun pitch to everyday investors as a way to get into big real estate deals. The branding is, you're with me, I'm rich, I know what I'm doing, I'll get you rich too. But then the market turns. Crypto gets wrecked, rates rise, financing gets tighter, and suddenly we're seeing reports of the jet being listed and luxury properties going up for sale. But it's even getting worse because what people started to notice wasn't just lifestyle cuts, it was the structure behind the scenes. Heavy leverage, multiple entities, related party loans, and a setup where the guru can potentially borrow against investor capital, move cash between entities, and still collect fees and control, even if the investments themselves are under pressure. Here's where things take a step further. Think about how a margin call actually works. You borrow money, pledge assets as collateral, the value of the asset falls, and the lender says, either pay us more cash or we liquidate your stuff. For a normal person, that's terrifying. For a skilled promoter with access to other people's money, that margin call can become just another tool. For example, if you control a web of entities, you can potentially borrow against investor-owned properties. Move that cash to another entity you also control. Use it to fund lifestyle, marketing, or other deals. Then, when things get ugly, you can blame market conditions while still being paid management fees and controlling the narrative. But then he said this unbelievable thing. We've heard the sales pitch version of this story for years. Real estate is safe. Cash flow never stops. Only suckers sit in cash. And my personal favorite, you're losing if you're not leveraged. Here's where things get interesting because leverage isn't evil. I use it in my own boring, unsexy way. In my early 30s, while everyone was chasing crypto, meme stocks, and 10x promises, I bought something dull that actually produced steady income. Didn't make me rich overnight, didn't buy me a jet, but it also didn't put me in a position where a 20-30% drawdown meant panic. What we're seeing exposed now with Grant Cardone is what happens when you mix high-leverage retail investors, complex fund structures, and a frontman whose brand is massive, aggressive, 10x everything. But it's even getting worse. Because if you're a regular investor in something like that, here's what you need to understand. You are the cushion. Your capital is the shock absorber between the guru and the bank. If values fall and loans get tight, the bank doesn't go after the influencer's Instagram. They go after the assets your money bought. And here's where things take a step further. Some of these setups include related party transactions. That means the person running the fund can also be on the other side of the deal. They can lend to themselves, rent to themselves, pay companies they control. So when there's a squeeze, guess who still gets paid? Hint, it's not the guy who put $5,000 in hoping for mailbox money. Here's where things get interesting. So what are the key takeaways from this whole margin call on Grant Cardone drama? First, leverage is a tool, not a personality trait. If your investment pitch sounds like a motivational seminar, step back. Real risk management never fits on a t-shirt. Second, if you don't understand the structure, you are the product. Can you explain, clearly, how your money gets used, who gets paid, and what happens in a downturn? If not, you're not an investor. You're an audience member. Third, lifestyle is not a balance sheet. Jets, mansions, private chefs, those are marketing assets as much as they are toys. They're used to sell the dream, and they're usually the first things on the chopping block when lenders start calling. But then the unbelievable thing happened. Once the market cooled, suddenly all the easy money forever guys had to act like serious capital allocators. And surprise, Some of them never built their businesses for a high-rate, low-liquidity world. They built them for one thing: raising more money. So what do you watch for next if you're trying to protect yourself? But it's even getting worse. Number 1, delayed or vague updates. When everything's great, you get constant hype. When cash is tight, you start hearing, "We're working through some temporary issues," "We're in conversations with lenders," or "We're exploring strategic options." Translation: something broke. Number 2, refinancing drama. Real estate empires live or die on debt. If you see a fund desperately trying to refinance, extend terms, or bring in new capital just to pay old obligations, that's not growth. That's survival mode. Number 3, related party smoke. If the same person is raising the money, buying the deal, managing the deal, and lending to the deal, you better be getting hedge fund level disclosures, not just an autograph on a book. And here's where things take a step further. In terms of how I plan to invest, I keep it boring on purpose. Simple structures, understandable cash flows, low leverage compared to the hype crowd. I want to be able to sleep at night if the market drops 30%, not film a crying TikTok. But in terms of my own plan for investing in these guru-style funds, here's what I think. If the main asset you're buying is someone's personality, I'm out. Give me an unsexy duplex with a normal loan over a billionaire's fund with 10 layers of legal entities any day. Here's where things get interesting. And if you're watching this and thinking, "I'd love to talk about this stuff without quitting my day job or going on camera," this channel actually runs on a system built for that. This video was created with Fludge.io, the same system that powers this entire channel. If you're watching this and thinking, "I'd love to run a YouTube channel like this, but I don't want to be on camera," this is exactly for you. Fludge researches, creates, and posts YouTube videos for you. Fully automated, but you're always in control. It finds trending topics in your niche, writes the script, creates the thumbnail, pairs it with an AI avatar, and uploads to YouTube. Your job is simple: review the quality and hit publish. You can jump in at any step, give feedback, and over time it learns your style. This isn't low-effort AI spam. If it were, you wouldn't still be listening to me right now. Finance, news, hobbies, education, whatever niche you care about, it can help you show up consistently without burning out. If that sounds interesting, check out Fludge.io. But then he said this unbelievable thing. Let's zoom out and talk about what this means for you right now. We're in a world where AI makes content easier than ever, marketing is louder than ever, and interest rates actually exist again. That combination is dangerous, because slick, AI-polished marketing plus real financial stress can create the perfect environment for desperate, over-leveraged gurus to pull every lever they can: fees, related loans, new funds, just to stay afloat. So your job is not to predict who's getting margin called next. Your job is to build a life where someone else's margin call doesn't wreck your net worth. That means no blind trust in personalities, no investing in things you don't understand, and no assuming that big and flashy equals safe. In terms of how I plan to invest, I'll keep doing what worked for me in my 30s. Boring, understandable, cash-flowing assets, diversified, with people whose incentives I can actually map, not just vibe with. None of this is financial advice. I don't know your situation, your goals, or your risk tolerance. Use this as a framework to ask better questions, not as a checklist to follow blindly. Now I want to hear from you. What do you think about the Grant Cardone situation? Smart operator in a tough market, or a leverage machine finally hitting reality? Drop your take in the comments. If you found this helpful, hit subscribe, tap like so more people see it, and share this with the one friend who keeps sending you guru clips on Instagram. I'm Thomas Paul. This is the comment section, and I'll see you in the next one.